Hello, scholars. My name is Joseph Ejike Oji, and in our lecture today, we'll be focusing on how to calculate the cost of preferred stock and the cost of common stock, which we also call common equity. So let's start with the cost of preferred stock. Simply put, the cost of preferred stock, it means the rate of return required by the holders of a company's preferred stock. When computing the cost of preferred stock, we have to factor in an important concept that we call flotation cost. So what is flotation cost? The flotation cost means the costs that are paid by a company that issue the new securities to the investment bankers. In other words, the cost of the flotation cost means the cost that are incurred by a publicly traded company when it issues new securities. So these costs, like I said earlier, are paid by this company to the investment bankers, the investment bankers that help them to issue that security. And in a nutshell, the flotation cost includes expenses like underwriting fees, legal fees, registration fees, and so on and so forth. So we can have to consider the impact of this. We have to consider the impact of the flotation cost when calculating the cost of preferred stock. Okay. Now, just making sure you're seeing this very well. Okay. Now, let's see. Note that preferred, when we calculate the cost of preferred stock, we use a formula that this formula I'm going to show you now. I'm going to make it a little bit bigger so you can see it better. So the component of the component cost of preferred stock, RPS, the acronym RPS is used to represent the cost of preferred stock. So RPS equals DPS over PPS times 1 minus F, where DPS represents the preferred dividend, PPS represents the preferred stock price, and F represents the flotation cost. Note that 1 is part of the formula, okay? Now, also, it is important to note here that the preferred dividends are not tax deductible. So the company bear the full cost. What does this mean? Well, it means that the preferred dividends are typically, when we say that they are not tax deductible, it means that the company cannot reduce its taxable income by deducting the payments made to preferred stockholders. Some company can, because of if they have so much debt, they can some debt can be cost of debt can be deductible when or I would say tax deductible, but not preferred stock. Okay. So now this is the formula for computing it. Let's see if we can do an example now. Look at this question. It says a company's preferred stock currently trades for $50 per share, and it pays $3 annual dividend. The flotation costs are equal to 3% of the gross proceeds. If the company issues preferred stock, what is the cost of the stock? So let's put our information here and that we are given in Excel, because that will make it easier for us to calculate the cost of the preferred stock. Again, you see that the company preferred stock trade at $50 per share. So let's go and put it in. We have preferred stock price is $50. Excuse me. Then next is we have the dividend. The company pays $3 annual dividends. So we have under then the flotation cost is 3%. So you go and put it. The dividend is $3. $3. Oh, excuse me, $3. And the cost of flotation is 3%, which is 0.03. Okay. Now note that 1 is part of the formula. So we can now calculate the cost of the preferred stock as follows. Remember the formula here is right here. Look at the formula here. Cost of preferred stock RPS is DPS over PPS 1 minus F, where DPS is the preferred stock dividend, PPS is the preferred stock price, and F is the flotation cost, and 1 is the part of the formula. So just plugging this in. Remember, when using Excel, you put equal sign first before you start typing the formulas. So DPS, which is right here, 3. Before we do that, I want to remember these are currencies and money. So I'm going to change them to currencies. Okay, good. So I will have equals DPS is 3 divided by, okay, you have PPS right here, which is I'm going to put it in parentheses, which is the preferred stock price, $50, times, actually is used for times in Excel, 1 minus flotation cost, this is 1 right here, minus the flotation cost of 3%, and then close the parentheses, and then press the enter key to give you the cost. So that's the cost, but it gives us the answer. It gives us the answer in decimal, so we can convert it to percent. I'm going to right click on it, choose format cells, and then we want 2 decimal places. Okay. Actually, I'm going to choose percentages. Just percentage. Choose percentage here, and I click OK. That gives me the answer, which is 6.19%. So the cost of this preferred stock is 6.19%. You can see how simple it is to calculate it. And I have it done as well in my PowerPoint presentation, so that if you want to use the calculator, you can also use the calculator to calculate it. Okay. So now that is for cost of preferred stock. Now let's look at the cost of common stock, or what we call common equity. So again, now the cost of common equities is usually viewed as the rate of return investors require on a firm's stock. Okay, so there are 3 methods we use when calculating the cost of common equity. Today we're going to look at the I will show you the 3 methods. 3 approaches we use. I say 3 approaches when estimating the cost of common stock, or what we sometimes call the market risk premium. The first thing to do is to calculate the historical premiums and use them to estimate the current premium. Or we can survey the experts. And when I say survey experts, it means that we approach experts such as financial analysts, economists, investment professionals, and then ask them to provide their opinion on the forecasts on what they believe should be the future market risk premium. So such an approach rely on the collective wisdom and insight of knowledgeable individuals, but it might be subject to biases and, of course, different opinion among different experts. We can also use the current market value, current value of the market to estimate the forward-looking premium, which is call it there, market, to estimate the cost of common stock. Now we can use formulas. Look at the formula we use here for estimating it. We have RM, which is represent the required return on the market or the cost of common stock. So RM equals to D1 or PO plus G, where D1 is the first dividend the new stockholder expects to receive or will receive at the end of the first year. PO is the actual market price of the stock today, and G is the expected growth rate in dividends, okay, as predicted by the marginal investor. So let's apply this. Estimate the cost of a common stock. Look at this question. It says, Dominion Resorts common stock is currently trading at $6 per share. The stock is expected to pay a dividend of $3 a share at the end of the year. That means D1 is $3. And the dividend is expected to grow at a constant growth rate of 5% a year. What is the cost of common equity? So what we're going to do now is to put our inputs, put them where they should belong. Okay. So we're going to say cost of common stock. So the first year dividend in the year one, we're going to get it from here. It says that it's $3. So we'll put it in $3. Then market price of stock today, PO. Market price of stock is at $6 per share. Okay. That's PO at $6 per share. Expected growth rate in dividends G. It said that it will grow, it is expected to grow at the rate of 5%. 5% change to decimal means 0.05. Okay. 0.05. Now let's calculate the cost of this common equity or common stock. We're going to use this formula. Okay. So equal D1, which is dividend, first year dividends. Okay. You know what? I'm going to put it in parentheses because we're going to divide it and then add G. So remember, these are currencies. So I'm going to make them currencies here. Currencies. Okay. Have equal, in parentheses, D1, which is the dividend in year one, divided by the PO, which is the market price of the stock today, close the parentheses, then times, use the asterisk sign, plus it, plus G, and G is the growth rate, which is this one here. Click on that, and then press the enter key to give you the answer in decimal form. Now I'm going to make it percent by right-clicking on it, format cells, and choose percentage. That'll give me 13.33%. I'm going to highlight it at the cost of this common equity, 13.33%. And as usual, I have it here as well for you. You can see right here, we have it on my slide, 13.33%. So I hope you enjoyed it. It's really easy. Now, this is one way of doing it. We can also use a different method to calculate the cost of common equity. The method I'm referring to is the capital asset pricing model approach. So we can use the capital asset pricing model to estimate the cost of common equity. So this will involve some steps. Remember that the capital asset pricing model is a financial model that describes the relationship between the expected return and the risk of an asset. So we can use that approach to calculate the cost of common equity. So to do that, like I said, we're going to involve several steps. Okay. First thing we need to estimate the risk-free rate. Then we need to estimate the current market premium, which are represented by RPM. Put it where current market risk premium, RPM. which is the required market return in excess of risk-free rate. Then we estimate the stock beta. Now, beta is BI. So what is a beta? And when we say a stock beta, we mean that it is a measure of how volatile a stock is relative to a market, to the market as a whole. So in other words, a stock beta is basically measures how the volatile or how risky a stock is relative to the market as a whole. So, for example, an investor who is looking to looking for a relatively low risk investment might choose to buy a stock that has a beta that is less than 1, because that kind of a beta that is less than 1 has is lower, is less risky. Okay. So again, beta tells us how risky a stock is or how volatile it is relative to the market as a whole. Okay. So now so using that, we can use this formula. There are two formulas. Either you use this one, RS equals RF plus beta times RPM, where RPM means current market risk premium, and RF represents the risk-free rate. I'm going to explain what it means in a few minutes. Or you can use this one, RS equals RF plus beta RM minus RF, where RM represents the expected return on the market portfolio, like S&P 500 index. Okay. So now, depending on what you are given, if the question gives you this, which is the current market risk premium, then use this formula. If the question gives you this one, then use this one. Okay. Now, how do we figure out what a risk-free rate is? Or how do we figure out what a market risk premium is, or what a stock beta is? How do we figure those things out? Okay. What we do is we estimate them. If they are not given in a question, we estimate them. How? Well, let's start with the risk-free rate and the market risk premium. Now, for the risk-free rate, we use the, of course, as you know, no asset is actually risk-free, but the US Treasury securities are assumed to be risk-free because America have never defaulted on their debts. So we can use the yield on a 10-year Treasury bond as a risk-free rate. How do we find that yield? And you can get it from several. You can get it from some websites, or you can get it from Wall Street Journal, or from the Federal Reserve Bulletin, or from Yahoo Finance. I can show you where you can get the yield. Let's see. I think I have Yahoo Finance somewhere, but I don't have it. I can open it. Okay. Let me see if I can open Yahoo Finance. Yahoo Finance. I'm gonna open it from here. Perhaps Finance. Okay. So you can see right here. You can see the I'm gonna make sure you're seeing this. Okay. Good. So you can see the 10-year bond. 10-year Treasury bond. It's gonna be somewhere here. Okay, right here, you can see right there. So you can use the return on this to represent your risk-free rate. Yeah, I think that I want to open it, but system is frozen. Okay, I think it's open. I can see the return right here, 0.79%. Can use that as the yield as a risk-free rate. Alternatively, I mean I think that's good enough. Now for the other input, which is market risk premium, you can use the historical return on US securities, which we can get from some website agents, like the website of some agencies like the Ibbotson Associates. Or you can just survey experts, to identify what they think will be the market risk premium. Now, okay. Now, But usually in the equation, they'll give you, they'll have you all this information available for you. Now, how do you estimate beta? Well, you can use this formula here. BI equals DI over, no, sorry, delta I over delta M times rho IM, where delta I represent the standard deviation of the stock I return. Delta M is the standard deviation of the market return. Then rho IM simply means the correlation between stock I return and market return. Alternatively, you can just use what we call the slope of a regression, whereby you can use the company stock, the company stock prices, sorry, the return of the company stock over several weeks or several months on the y-axis, and the return on the market index, for example, S&P 500 on the x-axis. So the slope of these two will be the beta for that stock. Now, some websites estimate beta too for some stocks, because you can use that. For example, like OpenWive, Yahoo Finance. Let me see this company. Let's see Walmart, WMT. Let's see if they have the beta on it. Okay, let me see. Walmart. Walmart is okay, let me see. Walmart. Yeah, I think I mentioned Walmart is WMT. So how come? Yeah, I wrote it down. WMT. Okay, to open it up, let's see if they have beta for them, Walmart here. So we look at the statistics. Look at the statistics. Okay. For that they have. Sometimes they have the beta for them. Oh, actually, no need to go to statistics because you have the summary here. You can see the beta here for Walmart. Let me go back to the summary. So you can see the beta right there. See beta as 0.49 right there. See for 5-year beta for Walmart, 0.49 right there. You can use that as well. Okay. So let's see. I think what this Yahoo Finance is let me just close it. Now we can go back to our work. Now let's look at this example. It's an illustration. It says, in this case, all the beta is given to us, all those information are given to us. Usually in a for students taking an exam, they will give you all this information. And then you can just use the formula and calculate the cost of common equity. But for a professional working, for an investor, for a client, you can get this information in different sources that I just explained. Okay. So look at this. We have this question. Put it right here. It says, this is an example of how to use the capital asset pricing model to calculate the cost of common equity. Excuse me. See, Bookstores has a beta of 0.8. The yield on a 3-month treasury bill is 4%, and the yield on a 10-year treasury bond is 6%. Market risk premium is 5.5%, and the return on an average stock price average stock in the market last year was 15%. What is the estimated cost of common equity using the capital asset pricing model approach? For this, we need only these three inputs. This one, other inputs are good, but we need only these three: the risk-free rate, the market risk premium of RPM, and the beta. So let's go and put them in. Let me write them down. So the risk-free rate is 6% according to the equation, 6%. RPM, which is the market risk premium, is 5.5%, and beta is 0.8. Now, because of because these are what we are given, it means that we're going to use this formula here. We're going to use this one right here. This one, that's what we're going to use because that's what we are given in this equation. If the question gives you input for this, then use that one. So that's what we're given. We're going to use it. So we can now go to our Excel and put them in. So we have the risk-free rate is 6%, which when we change it to decimal becomes 0.06. Market risk premium is 5.5%. When you change it to decimal, it becomes 0.055. Or if you don't know how to change it to decimal, I can show you. What you gotta do is to divide by 100. So equal 5.5% divided by 100. I'll give you the answer right there. Say that beta is 0.8. So that the cost of common equity now becomes, common stock becomes risk-free rate plus, then you have a beta, which is 0.8, times, remember asterisk is the symbol for times in Excel, times the risk market risk premium. Press the enter key, give you the answer, and then right click to make it a percent. Format cells, choose percentage. 10.4%. You can see right there. 10.4% is the cost of the equity. And again, I have it done in my presentation, so you can, if you want to use calculator, you can also do it there as well. So this end our lecture today. I'm sure you enjoyed it. I hope you enjoyed it. If you do, please subscribe to my channel so that you'll be notified each time I have a new lecture available. In the coming next lecture, we will be covering how to use the discounted cash flow method to estimate the cost of common equity. That'll be in our next lecture. Thank you for listening, and I see you in my next lecture. Have a good day. Bye-bye.